Hi, welcome back. You're watching MF Corner. Now, probably everybody has noticed the kind of rally that the equity market has been seeing over the last many weeks, and a lot of people are wondering that, hey, I've recovered some money now on my portfolio. Should I redeem and lock in at least whatever I have made so far? Well, Harshvardhan Roongta, Roongta Securities says it's not a very good idea. Why is that? Hi, Harsh. Good afternoon. Why should people not look at redeeming?
Good afternoon, Sumera. It's a very pertinent question at this point in time because we do come across a lot of such queries because we've seen markets tank by about 40% in the last 3 months, and that recovery has also happened. All those investors who've actually invested just at the peak of the market before the downfall started, I mean, they suddenly see an erosion of 30 to 40% in their portfolio. So it is heartbreaking for them. Now imagine a situation markets have recovered again and all these people have got back to their capital, the principal amount that they invested. The first investor psychology is that, well, let's just get out of this. It was not what I should have done. It gave me a lot of sleepless nights. So let's just redeem and never come back to stock market again. So this approach is really not right. I'll tell you why. Because, in any portfolio, you would need some portion of equities because equities do have the potential to give you a return which is more than inflation. So in real sense, if something really makes money for you, it is equities over a longer period of time. So, it's also said 90% of the portfolio return is attributable purely to a proper asset allocation plan and 10% is relating to whatever market timing actually does for your portfolio. So in ideal situation, let me just explain this, that when do you advise an investor to exit out of or redeem out of equity mutual funds or equities for that matter? So situation one would be that you have a goal which is next 1 or 2 years from now. So there is some need for this money in the next 1 year or 2 years probably. So in that sense, it makes sense to remove money from equities and put that into a debt product because you don't want to take the volatility of equity markets at the last moment. Imagine a situation in April you needed money for funding your children's education and you've kept your money entirely only in equities and the markets start going down. Then there is a problem. So what do you do in such situations? If you have a goal which is 1 or 2 years away from now, remove the money out of equity, park it into debt so that there is no last moment volatility associated with that money and your goal. So that is situation one. The second situation, in some cases we've noticed that investors, when putting in money, they set a price target, a returns target for themselves. They say that if my money grows 20%, for example, this is not literally the figure that I'm referring to. For example, if I get a 20% return on my investment, I will book profits at that point in time, park my money into another asset, and then probably come in later on when I believe that the markets are more suitable to invest into. So you have a returns target on your portfolio. That is probably at times when people try and book a profit because they've got and achieved the targeted return. The third set of investors would be that they invest into markets looking at certain market PE level. So there are certain parameters which say that if the market PE is say below 12, then you should have an equity exposure of say 90 to 100%. If the market PE is at probably a 16 to 19 band, the equity exposure that you have in your portfolio would be say between 65 and 75. Currently, we are in the market PE band of between 22 and 26. Now, in that case, you should have an equity exposure of say probably 40 to 55%. So, in case you are at this level right now where you had invested a lot of money earlier when the market PE was low, and now you're making certain gains because obviously markets have gone up, you may moderate your portfolio. You may come across and say, I want to rebalance and come back to my asset allocation plan wherein I will reduce certain portion of equities to come in the band of say probably 40 to 55%. But you don't redeem only because of one reason, which is that markets had gone down 40%, now they recovered 40%, I'm getting my principal back, so hey, let's just remove money out of this and go out of the market completely. That really isn't the right approach that you should take for your portfolio.
Well, just to take our viewers through what Harsh means when he says PE, well, it's nothing but the price to earnings ratio, which provides an investor with, the ratio of a company's current share price to its earnings per share, or the price which the market is willing to pay to sort of acquire that stock. So therefore, a high PE, like Harsh was saying, means that the market is bullish on that stock, and, as well, it may also indicate that the stock could be overpriced. And what do you mean by an index PE? which is what Harsh was referring to, it's nothing but the average PE ratio of the components of that index. So that, Harsh says, is a good indicator of how you can sort of measure what should be your equity allocation at that point in time. But Harsh, a lot of people are of the view that they keep waiting for that correction. So they say, you know what, even if I don't redeem, I will not put in fresh money. Okay, so if your advice that don't redeem right now is taken, what do you say to people who say that let me at least hold off on putting in fresh money into the market?
So, well, your investments are always going to be linked to an asset allocation plan. So, if at this moment in time, say suppose you have 100 rupees invested, of which you are deciding for yourself that I need about 55% into equities and the rest will be into debt. The moment you have an incremental investment putting in, suppose you're continuing with investments but not into equities, you decide I will keep only into debt, then the ratio automatically keeps getting tilted towards debt. For example, so now you're not doing anything, you're leaving as it is. The fresh investments that you make continue to go into debt. So your equity allocation will keep dropping from 55% to 50 and then going lower. So the idea is very clear. You have to stick to your asset allocation plan. If you are deciding to continue to invest in future, then that proportion of 55% needs to go into equity. And I want to reiterate one more point again. Over long term, equity is the only asset class which actually helps you get a real return. So while you're investing into debt, you may get a return which is say probably a 5, 6, 7 or 8% for that matter. Post-tax and all those implications, the returns will be lower than what actually that money can buy over a period of time, which is inflation. So the question is, why do you save money? You really want to do something more with that money in future than what you can do today. And if your same 100 rupees cannot be buying the same stuff that you buy today in future, there is no point of investing. So you will need to allocate some portion of your money into equities so that as a combination of equity and debt, you will really get real return. Now, one more point I want to highlight over here for an investor who actually, so there are two kinds of investors that we will address to right now. One is who's very comfortable with equity, so no problems at all. I mean, they understand equity volatility, so they continue to invest. The situation too, wherein an investor is very apprehensive about investing. So we divide this segment into two parts. One is that you're apprehensive, but you still want to, kind of take exposure, but you don't know what to do. So SIP is the route to do. I mean, that's the point. That's the essence of SIP, that you continue investing at all levels in the market. It goes up, you're buying regularly. It goes down, you're buying regularly. For the other set of investors who have, in the last probably 3 to 4 months, they've had sleepless nights, they've got anxiety about what equity investments are doing, then you were not an equity investor in the first place. I mean, you must understand this. So if you have really got those sleepless nights, you don't, you were very anxious, and in that sense, you were, you were getting, blood pressure issues because of this, then equity is not an asset class for you. Then in that case, yes, there is no option but, stay out of equity completely. So you decide what you really want to do. Don't force yourself into equities, because if you don't get peace of mind, there's no point in investing. If you can manage the volatility, by an SIP, please take that route. If you understand equity better and you can take lump sum bets in it, please go ahead and do that. So there's room for everybody and there's a solution for every investor profile.
Alright, and we have a viewer query who's also looking for a solution. Mr. Sampath Iyer has written to us on Twitter. So he's a retired gentleman who has invested 10 lakh rupees in the HDFC equity fund about 2 years ago. Now Mr. Sampath says that even today he has not recovered the principal amount. He wants to know if he should switch out and move to Axis equity fund. So speaking of redemptions and switches, Harshvardhan, what would you say?
Sumera, this HDFC equity fund, yes, has been underperforming, not just from the last 2 years, but it's been some time that for whatever reasons the fund hasn't been doing very well. Now, this is the case with almost all the actively managed funds. So, actively managed funds will have their cycles wherein wherein some bets, some investment calls taken by fund managers suddenly start very well. Sometimes they do land up taking calls which are not still fructified. So this will always be the case with an actively managed fund. Now, if I look at Axis, that's his other choice. As an AMC, Axis has been doing extremely well in the recent times. So, this is similar to a situation where HDFC equity fund, for that matter, did very well at one point in time. So, at all times, when you're in an equity, when you're in actively managed fund, you will continuously have the situation wherein, there will be a patch where your fund manager may not do well. Well, because the gentleman who's put in the query is a retired individual, I appreciate the fact that he wants to be in equities, which is a good thing to do. I would recommend that he invest in an index fund. Index funds are, they do not have these kind of, human biases wherein you have some fund doing well at one point in time and the other not doing. So being in equity but in an index fund will be the right solution for this gentleman. And since he's already with HDFC, he already has a folio there. I would recommend that he switches out of an HDFC equity fund into the HDFC Sensex fund. So I think that will solve his problem of this, which fund house, which scheme to take at all points in time.
All right, Harsh, appreciate your time. Thanks very much for advising our viewers. With that, we'll wrap up on MF Corner. Do keep sending us your queries and do stay tuned. The team of Closing Bell joins you next.